Hi, hello, welcome friends. In continuation with last class. So in last class we are started with mutual funds chapter. So what is there in mutual funds? We have started the introduction, how it will come, how it will work. It will pull money from the investors and it will invest in various sources and it will get the profits and it will share it. And mutual benefits, what is mutual benefit? Who can invest mutual benefit? These small retail investors, this salary person, they will invest in mutual funds, and how they it work, these are discussed. And should we invest stocks or mutual funds, means it will depend on your knowledge. So that is the major point they we are discussed in there. And classification of mutual funds, in classification we have functional classifications are open-ended, closed-ended and interval funds. Open-ended means you can enter or you can exit at any time. Closed-ended means you can enter and you can exit only the period of fund, the fund is specified time. And interval fund means in this fund they will provide some interval dates in between the fund maturity sum or fund term period, that is explained in yesterday class. After that, portfolio classifications, how the stock price may go, how the company will get the profits. Here we have equity funds and debt funds. So everyone has for sources means equity capital and debt capital. So in equity we have growth funds, aggressive funds, income funds. Growth funds means here what is their capital appreciation. For long term capital appreciation it is growth funds. And aggressive funds means where you, if you have 100 rupees, you are investing more amount into equity, it will become the aggressive. If you have 100 rupees, you are using more amount in debt, it will become conservative. And income funds, so it will be investing in safe stock with high paying dividends. Next, debt funds we are discussed. Here debt funds means we have two funds, one is bond fund and another one means gilt funds. Where bonds means corporate bonds means which will companies will issue, gilt bonds means where government will issue. So for this bonds, here fixed income securities will issue. So these bonds may government bonds or corporate bonds or convertible debentures or money market instruments, or these all will come into bond funds. Here these have different risks will be there. Risk will be interest rate risk, credit risk and prepayment risk and reinvestment risk. After that we have discussed about gilt funds. After this equity and debt fund we are discussed about special funds. In special fund we are discussing majorly four types of special funds. One is index funds. Index funds means that total out of the companies, one company is there in index, now we will invest in that index. Means it is like a one basket, different items will be there. The same has different company shares will be there in that index, we will invest on that index. Where has international funds, so we will raise money from globally. And offshore funds means here we have onshore funds and offshore funds. Onshore funds means where the fund is registered and you also there in there, then it will become the onshore fund. Offshore fund means the fund is registered in another place other than the main fund is exist, and that offshore fund will collect money and it will feed to master funds. And after that, sector funds. Here sector funds means different sectors will be there, that information technology or pharmaceutical or infrastructure, that funds. Next, money market funds. Money market means what? These short term funds which have commercial papers, that 90 days bills, etc. Fund of funds, you do not have much knowledge on other sector fund. So you are in real estate but you don't know about infrastructure, but you want to invest in infrastructure, then already infrastructure fund, the professional excellent professionals will be there, they are maintaining, so you can invest in that fund, simply diversifying the risk. And capital protection oriented funds, so whatever the capital you have, so capital oriented schemes means here mutual funds will designed or which endeavor to protect our capital invested. Means our persons was invested 100 rupees and you are investing in one fund and or one security, you majorly focus on first we will get back our principal amount, after we will get back some amount. And here they are we are discussing about one hurdle rate means minimum benchmark return we will get, that all will come in this place. And after that we are discussing about gold fund. So last class we are stopped there itself. Now in continuation with that, class. So CA final mutual fund. Welcome to CA final classes. Now gold funds. Here gold funds means the objective of this fund is to track the performance of gold. So the gold rate are increasing day by day, day by day, day by day. So they will track the performance of the gold, and the units represent the value of gold or gold related infrastructure held by the schemes. These gold funds, which are generally in the form of exchange traded funds, ETFs, or which are listed in stock exchanges and offer investors an opportunity to participate in the bullion market without having to take physical delivery of goods. So what is there here? There is their risk and reward potential for type of funds. So generally risk and rewards go hand in hand with mutual fund investment. Here we have in investment mutual funds, we have three category of risk. One is high risk, and one is moderate risk, and another one is lower risk. If it is in lower risk and return means we will in money market funds, means which is short term funds, which is short term and intermediate term bond funds. Or moderate risk, it is long term or bond funds, whereas we have balanced funds and growth and income stock funds. And after that higher risk funds means it is aggressive growth stock funds, where growth stock funds will be there. Aggressive means what? We are investing more amount into equity, it will become the aggressive fund. When we are investing more amount in debentures, it will become the conservative funds. Now quanta funds means what? Here in quanta funds work on a data driven approach for stock selection and investment decision based on predetermined rules or parameters using statistics or mathematical based models. Means quanta means we can use more data, we can use more technology, we can use different data. So quantum means different, more data means based on more data we can take the decisions. We have predetermined rules, parameters, statistics, mathematical based models, where here the while active fund manager select the quantity, price of shares and timing of investments, that is he may enter at any time or exit at any time. It is open ended now based on his her analysis and judgment. So he will see the past trends of the fund and he will take the decisions. In case of quanta funds, a complete reliance is placed on the automated program that help in taking decision for quantum of investment. So here more technology will be used or more artificial intelligence will used. So past 50 years data we can put in that one and it will show one decision, one analysis. For example, if you are using Excel, in Excel we have peer chart. So in peer chart it is easy to find which is increasing over 50 years, over 100 years. So if you see in Excel sheet, it is not easy to find which is good company, which is performance is good company. Then if we go with the peer chart, then it is easy to identify which is in increasing trend. And the automated programs that help in taking decision for quantum of investment as well as its timing and actions, and concerned manager has to act accordingly. Now however, it to be noted, it does not mean that in this type of fund there is no human intervention at all. So there must be human intervention will be required, because without human intervention the artificial intelligence also or technology also can't do anything. So because you need to open that and you need to put the inputs. Whenever we put the inputs in at AI, we need to prompt engineers will be there. Prompt engineer means they need to give the prompt to that chat GPT, then only it works. So how you are prompting is main important. So if you are prompting nicely, they will provide the answer nicely. Customized answer will be get only your prompting is proper way. Though the person must require, even though chat GPT or technology is increasing, the person must be required. And but the person will be required, they have some knowledge on that technology will survive, because the fund managers as usually focus on the robustness of the model in use and also monitor its performance on continuous basis, and it requires some modification is done in the same. For example, if you are opening some sites, they will ask robustic test, means they will give some pictures and you need to identify, or they will need to give them some captures, you need to identify and write. They will give some additions, you need to perform his. So it will not perform the robots that whatever the information technology, it won't work that places. Only when we give the prompt, it will give the solution. Otherwise it cannot do on his own anything. Now this is the case. So yes, sometimes the term quanta fund manager is confused with the term index fund manager, but it should be noted that both terms are different. Means quanta fund manager is different, index fund manager is different, because while index fund manager entirely hands off the investment decision purely based on the concerned index, the quanta fund manager designs and monitor models and make decision based on the outcomes. So in index fund manager, he will use his own mind and he will take one decision, whereas quanta fund manager, he will put all inputs into one technology and the technology will give one output. That output will be taken in consideration by this quanta manager. The primary advantage of quanta fund is that it eliminates the human biasness and subjectivity, and by using model based approach also ensure consistency in strategy across the market conditions. So here, what is the advantages of quanta fund? Means advantages will be, you can eliminate the persons who are required, that human biasness is removing, and subjectivity will be model based. So you can use in chart type, or you can use in p chart, or you can use in tree model decision, you can use in bar chart. So any one it will provided. And in addition to that, since the quanta fund normally follows passive strategy, here their expensive ratio generally tends to be lower than the actively managed mutual fund scheme. So expense ratio is the main important financial ratio in mutual fund, that IRR and this expense ratio, these are most important ratios. We need to highlight these ratios, that IRR and expense ratio. So we will discuss in later. We have the expense ratio, one formula will be there how we can utilize it, and generally tends to be lower than the actively managed mutual fund scheme. One side, since quanta funds are tested based on the historical data and past trends, through cannot all through be ignored, but also cannot be blindly has good indicator. So it is not good almost trusting that one only. It is not on, you need to believe, means you need to have some idea, then only it will work properly. And the overall it can said that when whether it the man or machine, it is not easy to beat the market. But it is because market will work on some trends, some demands, whatever the demand and supply. You cannot assume whatever you get the results, it will same market will work. Market won't work based on our data. We can take market data, based on market data we will come on conclusion. The conclusions may be differ, means from person to person. Next, ownership classifications. Yesterday I did this one direct plan, I don't know. So ownership classification, here funds are classified into public sector mutual fund. I think this was completed here. Okay, next. No. I won't completed. This was last time completed. Just a second. Okay. So for this, ownership completed. Here mutual funds are classified into public sector mutual fund, private sector mutual fund, and foreign mutual funds. Public sector mutual fund is sponsored by the companies or banks of public sector. So public sector banks is there, they will sponsor this mutual funds, and whereas private sector mutual funds is sponsored by companies of private sector, and foreign mutual funds is sponsored by foreign companies operating from India or for raising funds in India and investing those funds in India. Next, direct plans in mutual funds. Here what are the plans will be there in mutual funds? Firstly, investors were permitted to make direct investment in mutual fund scheme and even before 2011, but there were no separate plans for these investments. So direct plans means here you can invest directly, and these investments were made in regular plans and were tagged with the single NAV. NAV means net asset value. We will calculate the NAV, how we will calculate and how it will work we can see later on regular plans. And here there are an investor was forced to buy mutual funds based on the NAV on regular plans. So here firstly directly plans means they have directly the person, if the investor want to invest he can directly invest, whereas regular plans here NAV will come, means regular plan the one person in middle, one person will come to investment, so you need to go through with this person, that is regular plan. He will calculate one NAV, based on NAV they will give the units. However, these things will be changed with introduction of direct plan by SEBI on January 1st 2013. Here mutual funds direct plans are those plans where AMC, that is asset management company, do not charge distribution expenses or trail fee or transaction charges. Means direct plan means the investor will directly enter into the mutual fund, so they do not have any middle person, means agent is not there, so you cannot chargeable any fees or this charging distribution expenses or trail fee and transaction charges. Only they will charge the management fee because they will manage our fund, whereas NAV of the direct plan is generally higher in comparison to regular plan. So they have higher in NAV will be higher because we do not have expenses. Now when expenses are not there, the income all will accumulate in the NAV, because then NAV will increase it. Next, whereas studies have shown that direct plans have performed better than regular plans, or for almost all the mutual fund schemes to extent of lower fee charged by the mutual fund companies. So in direct plans we have less charges, in regular plans we have more charges, and in regular plan we have one agent person will be acting, he will tell, he will inform your information, he will give some guidance, so for that they will charge some amounts, different types of fee they will charge, because it will become expenses, then it will become expenses. Next, types of schemes. So what are the schemes? One is balanced fund. Here balanced fund means balanced funds make strategic allocation to both debt as well as equity. So source of capital means we have debt and equity. It mainly work on the premise that while the debt portfolio of the scheme provides stability, the equity portfolio provides growth. It can be ideal option for those who do not wish to take total exposure to equity. Who want to take total exposure means who person don't want to take more exposure on equity, means only exposure in equity, then it will better to go for the limited exposure. Then such fund provides moderate return to the investor, as the investor are neither to take risk. So if you are investing more in equity, it will become the high risk. If you are investing more in debenture, it will become the low risk, but you will get the low return. So for we need balancing the both, means risk is balance with the return. We need return and we don't want risk, so it is better balanced funds. Diversified equity fund. So what is meant by diversified equity funds means don't put all eggs into one basket. That is the simple quote we can use in entire mutual funds, because this mutual funds concept only that one, because they do not invest in single asset, they will diversify the risk. Here a diversified equity fund is a fund that contains a wide array of the stock. So here the fund manager of diversified equity fund ensures high level of diversification in its holding, thereby reducing the amount of concentration risk. So they will reduce the risk by investing in different funds. They will diversify the risk. Now what are there in funds? So one is flexi cap fund and multi cap fund and contra fund, index fund. Here flexi cap fund means these are by definition or diversified funds Under this category, the fund manager is allowed to invest any proportion across market cap without any restrictions. So flexi fund means you have flexibility to diversify the funds. Here the fund manager will allow to invest any proportion across market capitalization. They do not give any restrictions, so you can invest, you have full flexible, it will become the flexi cap fund. In case of the other category, the offer document spells out minimum and maximum amount that can and need to be invested in different market cap stocks. This category offer true diversification to the investor and lot of flexibility to the fund manager. Here these categories offers true diversification of the investors and lot of flexible to the fund manager. So when fund manager have flexibility, he will think properly and he will invest which is better, return will provide, that is flexibility will be there in flexi cap funds. Next, multi cap funds. Under this category, the fund manager is mandated to invest at least 25% in each into large fund or mid funds or small cap funds, and remaining 25% can be invested at the discretion of the fund manager. So here only on 25% he has option, he can invest in anywhere. In flexi cap 100% he can invest in any funds. In multi cap funds you will use 25% in large, mid and small, and after remaining amount will be invested in this whatever in his discretion. This category offer diversification with a lot of discipline, has minimum percentage of assets has to be invested across all market cap stocks. Next, contra funds. So here contra funds means a contra funds invest in those out of favor companies that are unrecognized or undervalued. So it is ideally suited for those investors who want to invest in a fund that has the potential to perform in all types of market environment, as it blends together both growth with value opportunities. Investors who invest in contra funds should have the aggressive risk aptitude. So here the contra fund means invest in out of favor companies that are unrecognized or undervalued funds. So they will go with the which is the company is underperform, they will purchase that type of funds, or which is does not have unrecognized funds. So because they do not have the publicity, but they have much capitalization or much work they are providing, much profit is there, but they do not have much advertisement, the company is not known for more persons. Here suited with the investor who want to invest in the funds that have potential to perform in all types of market environments, and it blends together both growth with value opportunity. Investors who invest in contra funds should have aggressive risk aptitude. Means here when the company his name he is not knowing and we are investing in the company which is unrecognized company, it is means you are taking in a aggressive, means you have aggressive risk. Next, index fund. Index fund means here index we have Nifty 50 or Bank Nifty. This is index, means different companies is there in that box, that is index fund. Here index fund seeks to track the performance of benchmark market index like the BSE Sensex or S&P CNX or Nifty 50. Here BSE means one market, NSE means one market, and S&P means another market, CNX one market. So simply put, the fund maintain the portfolio of all securities in same proportion as stated in the benchmark index and earn the same return as earned by the market. So different companies will be there in this index. You can invest in that index, you will get the same proportion whatever the companies will get, whatever the market is getting, you will get that amount, that is index fund. And dividend yield fund. Here dividend yield fund means invest in shares of company having high dividend yields. Dividend yield is defined as dividend per share, that is DPS per share, dividend divided by the share market price. So DPS divided by market price. Most of these funds invest in stocks of company having dividend yield higher than the dividend yield of a particular index. So particular index means that Sensex or Nifty 50 whatever it may be. The price of the dividend yielding stocks are generally less volatile the growth of stock. So besides this, they also offer the potential to appreciate. So if you are going for the dividend yield fund, here you need to invest in shares of the company. Only when you have company shares on the date of record date, you will get the dividend. So you need to search which company is providing high yield of dividend. Some companies give the dividend in quarterly or half yearly basis. Some companies will give yearly basis, or some companies will give whenever they want. That will be based on the company's investment, means based on the company's mission or based on the company's objective. If company is manufacturing, they have their money all will be there in manufacturing units. So plant and machinery, where the some companies will cash flow is regular basis is there. These software companies, these companies have regular cash flow, so they, so that they will you is issue dividend more regularly. Where we see Tata Motor company there. Tata Motor company will give the dividend 3 years ago or 4 years ago. Whereas this Infosys company is there, software company, they will give half yearly or yearly basis. So based on their where which the company is there in how they are performing, that all will factors for dividend. So when you if you want more dividends, you need to invest in shares. And among diversified equity funds, dividend yield funds are considered to be medium risk proportion. Here however, it is important to know that dividend yield funds have not always proved resilient in short term corrective phase. There are two options for earning income for mutual fund scheme, which are enumerated as under. One is growth or appreciation or cumulative options. Under this option, the investor does not get any intermittent income. So here growth, appreciation or cumulative option, here the investor will don't get any intermittent income. The investor get income only at the time of withdrawal of investment. So whenever he is in withdrawing the investment, then he will get the amount. So till the time of withdrawal, the return get accumulated and he is paid back to the investor at the time of withdrawal. In the related to growth option, means the growth option means whatever the dividend you are getting, it will accumulate to your fund, and whenever you are withdrawing, then only you will get the amount. That is related to growth or appreciation or cumulative option. And after that, dividend option. Here dividend option means here at regular interval, regular frequency, maybe monthly or quarterly or half yearly or annually, the scheme declares dividend into the unit holder of the scheme. So this fund manager will issue the dividend regular basis, declare regular basis. And dividend option is further divided into two sub options. One is dividend payout option, one is dividend reinvestment options. Means they will give the dividend whenever they are issuing, they will give to their unit holders directly, or the dividend amount means fund manager will get the dividend from the company. That dividend amount they will give directly, it will become directly payout, or they are using that amount to reinvest in other funds, it will become the dividend reinvestment option. So dividend payout option means dividends are paid out to the unit holders under this option. However, the NAV of the units will fall. So when dividend is paying, NAV will fall. And whereas to the extent of dividend paid out and applicable to statutory levies, whereas dividend reinvestment option will be there. The dividend that accrues on units under a option is reinvested back into scheme at X dividend NAV. Here the investor will receive additional units of their units, so NAV will increase here, so you will get the additional units. Next, equity linked schemes. So ELS means this will get the deduction under section 80C, provide deduction under section 80C in income tax. Whenever you are filing income tax returns, if you are invested in this ELS scheme, you will get the deduction, and you will up to 1,50,000 it is allowable. Here ELS also offer the perfect way of to participate in the growth of the capital market, having lock-in period of 3 years. How many years they have? 3 years is the lock-in period. Beside ELS, TDS have the potential to give better return than any traditional tax saving instrument. So moreover, by investing in an ELS through a systematic investment plan, so here we have SIP, systematic investment plan, one cannot only avoid the problems of investing in a lump sum toward, means if we have salaried person means you will get every month salary, other than that salary he don't have money, so he will getting every month salary now, he do not have the lump sum amount, so he is not able to invest lump sum amount in a single time, but he have capable to Q in monthly basis, then it is better for go for the SIP, that is systematically investment plan. In every month they will get to pay. One cannot only avoid the problem of investing in lump sum toward the end of the year, but also take the advantage of averaging. So whenever you are using this SIP, they will average the amounts. So first year you are investing na, first month amount you will get the interest accumulated with the second month, second month you are investing, second month and first month interest amount it will be accumulating, so that average benefit also you will get. Next, another one, sector funds. Here sector funds means these funds are highly focused on particular sector or industry, means IT sector, real estate sector, infrastructure sector, they will focus on these different private particular sectors. The basic objective is to enable investor to take advantage of industry cycles. So we have industry cycle, and that industry cycle you want to take the advantage. Since sector funds ride on market cycle, they have potential to offer good returns if the timing is perfect. So they will think this sector is going to be booming now, means at the time of corona we have this pharmaceutical companies were booming, we at that time when we the companies have name that does not have providing the hospitality services, they providing another services, some repair companies is there, but they have in the name some hospital or pharmaceutical name, that company shares also went like anything. That we need to see which sector is going. After that real estate booming, or after that we will see this entertainment sector also increasing day by day. So they will see which market is going, and based on that they will invest which sector is now booming, so they will assume, they will see the trends and they will invest in that type of sectors. And if the timing perfect is there, he will get the lot of money. They are more vulnerable downside risk protection as compared to diversified equity funds. Here sector funds should constitute only limited portion of one's portfolio, as they are much riskier than the diversified equity funds. Besides, sector funds are not suitable for first time investors into mutual funds. For example, if you are real estate mutual fund, invest in real estate properties and earn income in the form of rentals and capital appreciation from developed properties. Here also some part of for fund corpus is invested in equity shares or debentures of company engaged in real estate business or developing real estate development projects. So REMFs are required to close-ended in nature. What is this close-ended or open-ended? Open-ended means you can enter at any time, you can exit at any time. Whereas close-ended means they will give them certain time. So up to that time you need to stay in that fund. Otherwise they will not provide the amounts. Generally in mutual fund he is in open-ended funds, and that private equity funds will be in closed-ended funds. Next, thematic fund. Thematic fund means what? Here thematic fund focus on trends that are likely to result in the outperformance by certain themes or sectors or companies. So here thematic means themes, means which trend is going now, for example, if you see in YouTube which song is going trend, they will do, all these YouTubers will do that shorts, so short video they will do, so that based on that trend we will follow. They are also same, which trend is going now, which company is going crazy, they will invest in that type of funds. The team could vary from multiple sector, international exposure or commodity exposure, etc. So unlikely a sector fund or thematic fund have broader outlook, and however the downside is that market may take longer time to recognize views of the fund house with regard to particular theme which form the basis of launching the fund. Now another one is arbitrage fund. Arbitrage fund means here this fund promises safety of deposit here but better returns, tax benefits and greater liquidity. So what they will promise, one, safety of your deposit, and they will give the promise you will get the better return and you will enjoy the tax benefit and greater liquidity will be provided. Here open-ended equity schemes aims to generate low volatility return, means equity means always have more risk, but they will ensure that low volatility return by investing in mix of cash equities and equity derivatives and debt market. So they will divide these amounts into equity, derivative, cash market, and they will provide the liquidity also. So the fund seeks to provide better returns than typically debt instrument and lower volatility in comparison to equity. Here arbitrage fund seeks to capitalize on the price differential between spot and future price. So spot price means timing difference is there now. In here arbitrage means you buy in one market, you sell in another market. For example, you buy in Bangalore which is low cost, you can sell in Hyderabad, or you can buy in Hyderabad that Koti something market is there na, which provide the less price, less cost is there, you can buy in Koti, you can sell in other places. That is arbitrage, means they will see the whatever the different, means how much price you are buying, what is the future price you are going, the different will be the benefit of this arbitrage fund. Next, hedge funds. Hedge fund means who is the person get money, pull the money from the accredited investors. Here accredited investors means with these institutional investors or who have high net worth individual persons, they will accumulate this amount, means they will pull money from that person and they will invest in any asset. They do not have any restrictions to invest in any funds, so they will invest in any funds. And most regulations that these does not have the regulations, whereas mutual fund have more regulations, where private equity does not have that much of regulation, but this hedge fund does not exist any regulation, so they are providing escape most regulation by being a sort of private investment vehicle being offered up to selected clients. Here the clients also some selected clients which have big shots is there na, big shot persons, so they will focus on that persons who have the high capital more than 20 crores 30 crores, who that person they will focus on that person. Here big difference between the hedge fund and mutual fund, that his farmer does not reveal anything about his operations publicly and charges a performance fees. So anything about its operations publicly, whereas mutual fund they need to provide all information to public, whereas hedge fund they don't provide their information to publicly available because they have the investors only 10 to 15 members or less members in hundreds in hedge funds, but in whereas mutual fund we have thousands lakhs of people will invest, so all these persons want information, so mutual fund is need to provide the data into publicly available places, whereas hedge funds they don't provide the publicly data. They will prepare the PCAPs, that is partner capital accounts. They will give that capital account to their investors who are investing in the hedge funds. Next, it operationally public and charges performance fee, and the hedge funds will charge performance fee also, whereas mutual fund charge only management fee, but hedge funds will charge management fee plus performance fee because they think more, they want more, and they will maintain more, means this research team, their staff will be there, more persons will be there in hedge fund. Because of that they have cost is there, and because of their using that proper research team, using that proper data, they will get more returns, so they will charge more amount as compared to mutual funds. Mutual funds typically it outperform benchmark, it takes cut off the profits. Here hedge funds means whatever the market, it may be bullish trend or it may be bearish trend, they will try to get the more returns. And here the hedge funds are always aggressive managed portfolio, so they will invest in more risk, they will try to get the more returns, of which use advanced investment strategies such as leverage or buyout, leverage, long strategy, or short and derivative positions. What is this leverage? Leverage means what? Long means what? Short means what? Derivative means what? Leverage means, if for example here if you take balance sheet, so in balance sheet it is the fund house investment na. In fund house investment, this side liabilities will be there, it is capital, it is outside liability. So borrowing is more, for example 70 is borrowing and there 30, so in investment borrowing amount is more, to invest in this asset it will become the leverage. Firstly leverage, and after that next second one long term. Long term means whatever the capital, whatever the amount you will invest for long term strategies, so these all are long term assets, so this is long term strategy. And after that what is there? Short strategy. Here short strategy means, here firstly the person will come, this is one broker, I think one normal person, investor is there, and another person will be, one broker will be there, and he is thinking, in this person he is thinking in future, stock price will go down, he is thinking. When maybe in future means after 3 months, after this financial year end in April, the stock price may go down, he is thinking. So what is our motive? When stock price is down we need to buy, that is our motive, and when stock price is high we need to sell, then we will get the profit, the different amount is become profit now. So but in future the price is going down, as of now we do not have any shares, okay. What this person do na, he will ask this person borrow some shares. What he will do? Borrow some shares and he will sell in the market. So he will sell in the market. And after 3 months, as per his assumption, if the market share price is down, he will buy then. Then he will buy and he will return to this broker. This is what happened in charter. Means here the fund, the person investor is thinking future price will going down, so he will borrow some shares and he will sell in the spot market. He will buy when the price is went down and he will return to this broker, and when he is returning he need to pay the interest of this borrowing amount. So what is here profit means, with this different amount is there na, this different amount we will get the profit, but for this profit we need to deduct the whatever the interest he is paying na, here an interest is paying, after interest we will see the net profit. This is short position, means he is taking the short position. Next, derivative position. Derivative means we have futures, forwards, options, that is call option, put option, swaps, swaptions, different will there, you can use that one, and both domestic and international market with goal of generating higher returns, either the absolute sense or over specified market bench. It is important to know that hedging is actually the practice of attempting to reduce risk, but goal is most hedge funds to maximize the return on investment. Next, here cash fund. Cash fund means, here cash fund is an open-ended liquid scheme that aims to generate return with low volatility and higher liquidity. Liquidity means what? It is available to easily convertible into cash, then it is known as cash fund. Here through portfolio or is very short date debt and money market instrument. So cash fund offer growth and dividend options. Next, ETF. ETF means ETF means exchange traded funds. Here exchange traded funds are hybrid products that combine the features of listed securities and index funds. ETF means it is hybrid product. What is this? It is hybrid product which have listed option, listed stock option plus index fund option. So index means different shares will be there in one basket, that is index, and this index plus listed stocks feature will be combined, the hybrid product, then it is known as ETF. These funds are listed on stock exchange. So here we are the listed, sorry here, just a second, listed plus index option. So already there in stock, they are purchasing. Index means already there, they do not have the option to register now. Then whereas these funds means ETF funds, they can go in stock exchange and their price are linked to underlying index. The authorized participants act as market makers for ETF. Here ETFs can buy and sold like any other stocks. So ETFs will allow, for example, if you see that Reliance stocks is there, na, you can buy Reliance stock or you can sell Reliance stock. Same like as this ETFs, you can buy, you can sell, and the ETF buy and sold like any other stocks on the exchanges. In other words, ETF can bought or sold anytime during the market hours. Market hours means what? This 9:15 to 3:30 p.m. is the market timings at prices that are expected to be closer out to the NAV at the end of the day. Based on NAV means at the end of the day they will report the NAV, update the NAV. I think before 11 p.m. they need to update the NAV in every day, daily basis. Real time, one can invest at real time prices as against the end of the day as his increase is open-ended schemes. Next, another one here, there are no paperwork involved in investing in ETFs, or this can be bought like any other stocks by just placing an order with brokers. Here ETF may be attractive as investment because they have low cost. So for this ETF they have low cost and tax efficiency, and stocks features like stock like features, and ETFs combine the valuation feature of mutual fund or unit investment trust, which can be bought or sold at the end of each trading day for its net asset value, that is NAV, with the tradability feature of close-ended funds. Means close-ended funds means it is does not means anytime you cannot enter, anytime you cannot exit. They have their own times, so up to their maturity you cannot enter, you cannot exist, and which trades throughout the trading day at prices that may be more or less than its NAV. There are different types of ETF products will be available in the market. One is index ETF, that is most ETFs are index funds that hold securities and attempt to replicate the performance of the stock market indexes. So if we see what is the stock market performance, then based on that stock market performance it will hold the security. Next, commodity ETFs. Commodity means different commodity, they will take gold or rice, based on that price it will change the value. So commodity index ETFs invest in commodities such as precious metals or futures, etc, 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 etc. Next, bond ETFs. Bond ETFs means exchange traded funds that invest in bonds are known as bond ETFs. So where they will invest in bonds, they thrive driving economic recession because investors pull their money out of the stock market and invest into bonds. So for example, this government treasury bonds is there, or this those issues by companies regarded as financial stable. Because of this cause and effect relationship, the performance of the bond ETF may be indicative of broader economic conditions. Next, currency ETF. Here the fund are total return product where the investor get access to affect spot changes or local institutional interest rates and collateral yield. So currency ETF means this currencies is there na US dollars or euros, Japanese, GBDs. So they will see that currency based on the total return products. They will get to access the foreign exchange spot changes, local institutional investors rate and collector. I think next concept, okay, advantages will be seen in next video. Now fixed maturity plan. So here fixed maturity plan means are closely ended mutual funds. Closely ended means they will specify the time period. Up to that time period we need to stay in that fund only, in which an investor can invest during a new fund offer. Yes, NFO means where they will give certain time to invest. For example, today is the date, I think 20 means January 18 something. So for example, one fund is offering January 20 to January 30 is the new fund offer, means you may invest in between this time. This is known as new fund offer. So they will provide the time period for investing. Here fixed maturity plans has usually invest in certificate of deposits or commercial papers or money market instruments and non-convertible debentures over fixed investment period. Sometimes they also invest in bank fixed deposit. In new fund offer, during the course of which FMC, that is fixed maturity plans, are closed, issued or later traded on stock exchange where they are listed. But trading in FMEs is very less. So fixed maturity plan means they do not have up to maturity, then we need to stay na. So because of that they do not trade in market very high, it is very less. So basically these FMPs are not liquid instruments, because liquidity means what, easily convertible into cash, whereas in maturity, up to maturity you need to wait, means you do not have the liquidity na, that one. The main advantage of fixed maturity plan is that they are free from any interest rate risk. So you do not have the interest rate risk because they will provide the fixed rate. So in interest rate we have different types of interest rates will be there. One is fixed rate and another one is float rate. So these maturity plans will follow this fixed rate, whereas flat rate means we have different they will based on some benchmark rate, they will add some percentages. For example, Libor plus 2% or Mibor plus 2% or Sony plus 2%. So they will go in one benchmark rate, and after that interest rate risk, because FMEs invest in debt instruments that have some maturity as that the fund, however they carry credit risk will be there, because we have long term now, the company may pay that at the ending position. If the company does not have the money, they don't pay. So they promise the pay but they won't pay the amount because they do not have the amount. So that credit risk will be there. So we need to, whenever we are investing in the company, we need to see the credit score of that company, which give this credit scoring companies will give triple A plus or triple B grade, C grade, that Moody or S&P or Credit Crystal. These companies will provide the credit rating. Has there is possibility of default by the debt issuing company. So if the credit rating of an instrument is downgraded, the return of FMP can come down. Now presently most of the FMPs are launched with tenure of 3 years. So what is the tenure of 3 years will be the tenure to take the benefit of indexation, but because of longer maturity period they find it difficult to provide good returns in the form of interest to investors in highest rated instruments. They for assign some portion of the invested funds in double A and below rated debt instruments. When you have high rating, means when you have low rating it has high risk. So when you have high rating it has low risk, means here only double A, we have triple A is there and triple A plus is there. So we will see which is high rated instruments to earn the higher interest. The reason is that low rated instruments carry high coupon interest rates. So why, when company is low rating means the person who are trusting this company is low. So when low person is trusting, the company will give more return. So some persons will see this return which is giving more return, so they will invest in this person. So when low rating is there, they will try to give the more coupon interest. That is main here fixed maturity plans. We will see these advantages in next video.